Ladies and gentlemen, welcome to FreeFX, your free Forex source of education and analysis. Today is Tuesday the 7th of July, and I'd like to introduce a topic today which is on everybody's mind, I'm sure, since the Greek referendum. And this is the general positioning of markets and where we as traders can actually find some hint as to where we should position ourselves, depending obviously on what type of trader you are, whether short term, medium, long term. I think this is possibly something that everybody might want to start thinking about in terms of where they might lose capital, protect capital in the medium term for the remainder of the year. The summer is here for the Northern Hemisphere. We have a draining liquidity usually in the summer months for the holidays. Wherever they are, they always have an impact. So it is crucial at this point that deals are struck and accounts possibly are are looked at before the break in terms of where the gains have been for the first half of the year. And it's important also to think about the Eurogroup meeting tomorrow, because with the new finance minister in Greece, there are possibilities in terms of the personal relationship between members around the table, although Tsipras is still the prime minister and leader of Syriza in Greece. The referendum on Sunday gave us a striking result, a no to the proposals from the Eurogroup in terms of the financial package that Greece has been asked to agree, and this has brought a gap down on certain assets. Difficult to speak of the markets. It is a wide-ranging field. I like to try and gather different sources to paint a picture as to where we are and where we might be moving. I would start obviously with a price relating to currencies, the currencies that we tend to associate with risk or risk factors or risk speculation, and the yen cross has come to mind as being a particular factor in when it comes to the carry trade, or when it comes to risk associated currencies like the Kiwi dollar, etc. Now, the Kiwi dollar in this particular screen is shown to you with an overlaid blue line, and that is the FTSE 100 shares index, or the London or UK 100 index. This actually shows, funnily enough, a correlation which you may not think at first particularly obvious, because maybe you might think the pounds might be a better overlay with this index. But I like to see this because this gives me an idea as to where markets, regardless of correlations, are actually going. So if we have a risk theme and things are aligning together, like equities with carry trades like the yen crosses, this is pointing towards what I might like to see, which is an idea of where I should go. In other words, is the market a bull market or is the market a bear market? Well, if you're trading against the euro at the moment, you might obviously call yourself a bull. So it isn't particularly straightforward that way. But if you are investing in the Kiwi dollar, for example, versus the yen or other yen crosses, and you see that it isn't just a Kiwi move, but there's an equities move to the downside as well, and they seem to be shaping in a similar way, then you might want to take a step back and see the wider picture in terms of where this is pointing the finger at. So before we broke down the FTSE 100 into its components and started arguing that it's because of the particular constituents of that index, the particular companies that make it up, or before we started talking about the historical trend that has been developing for the Kiwi dollar in terms of the Royal Bank of New Zealand's rate cuts, we might actually start thinking about looking at these as trading instruments and looking at the charts as a whole and see that they are correlated, and even if the correlation isn't something that we might have thought or reasoned with to begin with, it is there in front of us and we must take notice. So if the FTSE 100 has dropped from these levels of 7,100 and we're down currently at 6,500, it's almost 700 pips, so we must actually think that that isn't something that we can discount, especially as we've come down from historic highs, because these levels above are levels that we've seen coming back. And in this chart you can see in the FTSE 100 we have actually 3 cycles, and these 3 cycles all top around this square or this rectangle that I've drawn. So this area of supply between 6,500 and 7,000, this sort of 500 or 600 pip range. Okay, so they've all entered this area. Now you might argue that it's not been the same. The length in which they've been in this area has not been the same, and here it's slightly overextended. But this overextension is still part, of a 7-year cycle. So we could also say that the S&P 500 is overextended compared to previous highs. Okay, so if you took the S&P 500 on a monthly chart, you could see obviously that we are at historic highs, that these cycles, okay, are quite regular up to this point, and then we go higher. Whereas if you look at the UK 100, the FTSE 100 on the blue line here, you can see how much more regular it seems to be. Even this more overextended leg, which we're currently inhabiting, and does actually reflect the S&P 500, still is within a sort of more regular flow. So for that reason, I like the S&P 500 less, because it's not a more regular cycle in terms of how it's moved. But the UK 100, the FTSE 100, and the S&P 500 have a similar market cycle. As you can see, they are almost a copycat from the more visual aspect, if not the levels at which they arrived. So, and the fact that the S&P 500 and UK 100 have this correlation makes you wonder, if this is a particular top, then possibly we should pay attention when the Kiwi yen or other yen crosses and the FTSE 100 are starting to come down from an equities market high or other market highs, because obviously investors from different instruments and asset classes are actually thinking the same thing, and we must think also that there is something at play. Some people have discounted the Greek vote, and some people have made exactly a different argument, saying that, well, this could be the downfall. This could be the market movement towards a cleanse, where we see levels returning to more normal laws of market cycles, where there's a better correlation between supply and demand. And indeed, money flows through QE and the S&P 500, as shown as, have been fed a particularly toxic mix of easy money, which has propped things up to abnormal levels. So it is important to think of this as the beginning of the end, possibly. I'm paraphrasing the Monday edition of Power Trading Radio Show by Merlin Rothfeld, and the beginning of the end, because if this were a panic or fear situation, there would be a getting out scenario where people would be coming out of their positions and selling off long-term holdings, and they would not want to be left into risky scenarios or taking losses, and they'd be desperately trying to come out very quickly. I don't know who these people are, hedge funds, etc., possibly wealthy individuals, but I'm thinking more the smart money, as it's called, so banks and institutions who move the markets in more significant ways. We are obviously not trading in that realm of financial circles. So we have to really try to get the best probability out of our trades and be sure that when the market is moving in one direction, it isn't a false move. And there are many ways to do that. One is to look at correlations between asset classes like this. One is to look at volume, for example, which you might want to do in terms of retail volume and see what your particular broker gives you. This is FXCM, and there is a real volume indicator that we can use. I'm looking here at the DAX, the German 30 companies index, and you can see that since the news of the Greek so last Monday last week, since the news of the Greek referendum coming out, it fell a mighty drop here was created, and it hasn't really recovered since. We've fallen even further. So it is actually a considerable correlation that we can see between the different asset classes. The DAX has fallen considerably, the FTSE 100 has fallen considerably, and the S&P 500. On the hourly chart, you'll see that it is falling, and there's no denying that. In a very similar way, big candle here on the Greek referendum announcement, and then on the open this week after the Greek referendum, another big candle, and it was just about recovering, and it tried to recover, and we haven't really gone any higher. So it has made a new low since this week here. Okay. Now, just to finish, I would like to say that this leaves us with an open question, which is tomorrow, with the meeting of the Eurogroup and the new possibilities for assisting Greece, will this give the euro fuel for thought? Well, this is the euro pound, which is an interesting cross. Obviously, we've come down to June, at the end of June, on the announcement of the Greek referendum, down to the 0.70, and it's almost like a line in the sand. And if we made it into a wider view, you'll see that this goes back a long time, and we've had some time below it and up to 2007, and then some time above it, and we've come back right back down to here. So really, we've covered a lot of distance, and this is make or break time. So interesting times for euro traders who might be trading euro pounds, or for euro traders who might be trading, say, the euro USD, which again has been stuck in a lot of uncertainty recently over both the US dollar's own projections for a rate hike and the euro's uncertainties over Greece. So this is the daily for this pair, and obviously we have dropped, like with the euro pound, quite a lot. And I'd like to finish by overlaying the euro pound with the euro USD, and you'll see that they are moving now very much in a similar fashion. Okay, so they are coming to this situation where from this mighty drop we are possibly narrowing into a sort of range, and certainly there's a feeling that this could either go down to significant new lows or to historic lows, and certainly we don't look back to these levels as supply and demand, but just as a traces in history, if you like. So looking more closely, certainly these are new lows, and we've possibly bounced back from these in the euro USD, but it's potentially not a strong pickup, more of a short covering from people holding on to this and taking profit. So this could be just a relief move rather than a sentiment move in favor of the European Union. And depending on how you position yourself in terms of the euro, you might want to look at different pairs. Certainly going short at the moment is a risk, so you might want to consider pairs which are not directly affected by the European situation. Either way, we'll keep our eyes open, and thank you very much for listening. Again, like the video or leave comments and ask questions about your own trading, and I'll get back to you with some suggestions or answers or comments. Thank you very much, and good luck trading out there.